Okay, welcome back, everyone. This is another webinar series of our options education webinar series every Thursday. This week we are moving it to Tuesday because I'm traveling this week for the Money Show in San Francisco. I'll be speaking at that Money Show on actually similar topics for those of you that will be out there for that show. Welcome back. My name is Tony Zhang. I am the Chief Strategist here at OptionsPlay. And today we're going to be talking about how to generate consistent income with weekly options. For those of you that have seen this topic before, I have done quite a few updates to this specific webinar. For those of you that are brand new, welcome. This is a webinar designed to basically go over the 3 most popular trading strategies on how to generate income using options, and then showing you how to utilize weekly options to truly maximize your income for your portfolio. So we'll be talking about everything from cover calls to credit spreads to short puts as the primary strategies on how to utilize options to generate income. I'll be talking about best practices, when to use these strategies, but more importantly, what I want to actually do is show you how to use OptionsPlay so that you can take what you've learned here today in terms of best practices and immediately start being able to analyze real income trades on the stocks that you're interested in paying attention to and seeing instant strategies, analyzing them, and be able to execute them right off the bat. So before I get started, I see there's already a question asking if this webinar is the same as the last 3. And like I said, I have made quite a few changes to this. It is including a lot more than just cover calls, which is what I traditionally cover on this webinar. So for those of you that are brand new, welcome. This webinar is recorded, and I will be sending out the slides to everyone once we're finished. The slides will include important links, including some of our previous webinar recordings. Since I'm going to be covering quite a few different topics on income strategies, I highly recommend, if you're looking for specific ones like credit spreads or cover calls, please view our webinar recordings. We go into a lot more detail in some of those other webinars, and we have some important links for you as well. So you'll get that in the email right afterwards with the recording and a copy of the slides so that you can follow along after you're done. So regardless of whether you're brand new to options trading or if you're an experienced options trader, this webinar is really for all of you. For those of you that are brand new, I really hope that this inspires you to consider taking a look at options, especially on some of the more basic strategies that are easily implemented on portfolios where you own some stock, and even for more speculative strategies. And then for those of you that are experienced in options trading, I really hope that I can show you guys how to utilize OptionsPlay to make your lives a lot simpler in terms of research and really shave down the amount of time that it takes for you to learn, or how to, for those of you to find your right strategies, to shave that research down from just a few minutes down to a few seconds. And that's really the key of what I hope to show you guys here today. So today what I'll cover is what are the 3 top income strategies that typically use when we're selling options to generate income. We'll talk a little bit about when you should use these income strategies, how to generate consistent income using these strategies, and lastly, we'll talk about how to generate income strategies or looking at these income strategies with OptionsPlay. That's the tool that we'll be showing you guys here today, and I hope for those of you that are on a free trial or subscribers, please make sure that you follow along afterwards when you're watching the recording. And for those of you that have never heard of OptionsPlay, I encourage you to sign up for a free trial at optionsplay.com in order to see what we're talking about today and following along. So the top 3 income strategies. Now, before I actually talk about these specific ones, I just want to actually ask the audience a quick question. What income strategies do you primarily trade? Cover calls, credit spreads, short puts, or more complex ones like condors, butterflies, and straddles? Okay, so it looks like so far it's a pretty close tie between cover calls and credit spreads. Credit spreads are actually a little higher than I was expecting. It looks like about 1/3 of you trade short puts, and just a very few of you trade condors, butterflies, and straddles, which is expected. But I'm actually pleasantly surprised that credit spreads seems to be more popular than cover calls. So hopefully after this webinar today, you'll learn a few different things as well, and hopefully that might convince you to take a look at some of these other strategies. But it looks like by far credit spreads is the most popular one. About 60% of you trade credit spreads, 50% of you trade covered calls, and about a third of you trade short puts. Okay, great. So let's go ahead and get started. I'll break this down. We'll start off with cover calls because it is simply, in terms of sheer trading volume, it is still by far the most popular trading strategy amongst options traders. And it's simply because it's used for the existing stocks in your portfolio, which means you don't have to add any additional risk. If you own any stock in your account, you can immediately sell cover calls. It's what most people are approved for. And the benefit of it is it lowers the portfolio volatility and cost basis of the stocks that you own. Now, I will say that this webinar today, I won't go into details of each individual strategies. If you're looking for some of those details, we do have separate webinars specifically for that on how to construct a cover call, how to construct a credit spread. I'm not going to get into that. I'm just going to be talking more of these on a high level and talking more specifically about why you should utilize weekly options when it comes to these types of strategies. Next, I'll move on to credit spreads. This is really looking to collect income on any type of directional speculation. So if you have a directional view, you have a mildly bullish or bearish view on an underlying stock, you can use credit spreads to collect income on that specific view. And the best part about that is that it gives you the ability to take that directional speculation, generate some income, but still have limited risk and you don't have to own the stock. Unlike many other income strategies like cover calls or short puts where you either have to own the stock or you might potentially own the stock. Credit spreads really prevent you from having to take that piece of owning that stock or having to own that stock and still be able to speculate on direction. And lastly, short puts. This is a bit of a more advanced strategy, but I actually think it's quite underrated. Only a third of you say that you trade short puts, but if any of you trade cover calls, I really recommend you to consider taking a look at short puts because it's really for the stocks that you want to own, and there's going to be some stocks that you might want to own, but perhaps you don't want to buy it at the current price. Perhaps you think it's a little too expensive. Short puts really allows you to dollar cost average into that stock at a lower cost basis. So it's really something that I think a lot of people tend to overlook. People think of short puts as the strategy with unlimited risk, but it's actually the same amount of risk as owning the stock. When you own the stock, if the stock was to zero, you will lose all your investments. The same thing with short puts. So the risk of owning short puts is very similar to owning the stock, and it's really a strategy for stocks that you want to own. So I really think that for those of you that own stocks, it's an underrated strategy that I think you should really take a look into, and we'll explore a little bit of that today. So what is the actual strategy with each one of these three? And it's actually pretty straightforward. With cover calls, it's really for when you have a bearish to neutral view on the market. And I say that very loosely because you can trade cover calls even if you're bullish on the market. Just that if you're really bullish on the stock and you think it's going to take off really, really quickly, such as if there's earnings coming out, if there's a product announcement, those are the types of times where you generally want to avoid selling cover calls. But the one thing about this strategy is that it can be used in all volatility environments. Unlike many other strategies where they're generally better for high volatility or low volatility environments, we have found that cover call is a strategy that you can utilize pretty much in all volatility environments based on our back testing. So it's something that you can do day in and day out. As long as you don't have a very short-term bullish view on the underlying stock, you can sell cover calls on the stocks that you own. Moving on to credit spreads. This is a strategy that's really ideal for what we consider market tops and bottoms. And what I mean by that is really technical indicators that would traditionally give you an oversold or overbought reading. Those are ideal for selling credit spreads because it gives you a pretty good statistical measure that the stock is unlikely going to continue going higher in this, or it's unlikely going to go any lower. So if you think it's not going to go any lower and you think it's oversold, that's a time to sell a put credit spread. If you feel the markets are reaching a top and you feel that the markets are going higher or not going to go any higher, it's time to consider selling a call credit spread. And this type of strategy is generally best used in a relatively higher volatility environment. You can use it in a low volatility environment, but you may not find the same amount of profitability you're using it in a lower volatility environment. And lastly, short puts. This is really useful for those of you that have a bullish or neutral market view on the stocks that you want to own. Not something that you would do if you're extremely bearish on it in the short run. So basically the exact opposite of cover calls. If you're extremely short-term bearish on it, you typically wouldn't sell a put on that. That's pretty much the only time you wouldn't sell a put, and it's pretty much used in all volatility environments. Sure, when it's high, when it's low, when it's in the middle, these are all suitable times to consider selling puts and generate some income, which helps offset the cost of buying that stock. So really, three very popular strategies, all used for different scenarios. So regardless of what your views, you should be able to find some kind of income strategy that suits you and allows you to generate consistent income in your portfolio. I see a lot of people that are using income strategies tend to stick to one of these strategies, but I highly recommend you to consider expanding your views and looking at all three, because it really allows, because all three combined allow you to at all times be able to be generating some income in the market, regardless of whether you're bullish or bearish. One of these strategies will likely fit the current market scenario. So how do you actually generate consistent income in your portfolio using these strategies? So we talked about the three different strategies, the different market environments they're useful in. How do you actually generate consistent income? Because one of the most common complaints that I get from users that sell covered calls or short puts is that it works until it doesn't. People sell covered calls and then all of a sudden all their stock gets called away in a single month, and they say, oh, this wasn't, this is not what I wanted, this wasn't what I think it was going to give you. So the key to generating consistent income is actually just exactly that. Consistency is key. And what I mean by that is simply making sure that every single time that you're about to enter an income trade, make sure that you're choosing a suitable expiration date and strike price. And that should be based on your personal preferences, which we'll talk a little bit about in the next few slides, what those personal preferences are. And once you've determined what those personal preferences are, it's really important to use the same methodical approach each individual cycle. So I see a lot of users, if you're selling a covered call, they might do a 1 month call this month. Next month, they might be going out to 2 months because they see there's a little bit more premium in that 2 month option. Or they're getting a little bit more aggressive because they want a little bit more income because perhaps they had a bad month, so they're trying to make up for it by generating some additional income. That's where I see inconsistencies in people's strategies. So regardless of what your portfolio looks like that month, regardless of what your emotions are that month, I highly recommend, regardless of what your views are, to stick to the same type of expirations and strike price each individual cycle. And that's how you're gonna be able to get consistency. And the other thing in order to help you gain consistency is really automation. So if you use some kind of tool that helps you pick your expirations and strike prices, you're more likely going to stick to those. If you're picking them manually every single cycle, you're more likely to be inconsistent with your results. And that's really why I want to show you guys how to utilize OptionsPlay to help you find these strikes and expirations for your portfolio, because that's how you're going to be able to gain some consistency in your trading. Okay, so with that, what I want to talk a little bit about is those personal preferences. When you're selecting your expiration date, what does that look like? So I have three different types of traders, if you will, or three different buckets, if you will, and they typically help you dictate what type of expiration cycles are more likely to be best suited for you. So most of you will probably fall under this active trader type category. This is for those of you that are similar to me, meaning you have the time to look at your portfolio pretty much every single day, if not at least multiple times a week. If you fall into that category, you typically will trade shorter dated options anywhere from 21 to 49 days out. That's really where we're talking about that weekly option time frame. For those of you that are on the other end of the exact opposite end of the spectrum, for those of you that are buy and hold investors, this is where you're typically looking at much longer term options. So anywhere from 90 to 180 days out. This is for those of you that are trading longer dated options. For those of you that are only looking at your portfolio once a month or once a quarter, I recommend you to choose longer dated options as opposed to doing short dated options if you don't have the time to evaluate it. And then some of you will probably fall somewhere in between that. You might look at your account once a week, once every 2 weeks. You would want to typically look at maybe medium term options anywhere from 50 to 89 days out. So about the 7 week to 3 month time frame would be more suitable for you if you're looking at your portfolio once a week. So make a mental note to yourself, how frequently do you trade? Because that's going to help you dictate what expiration you want to look at. And I just want to point out kind of what the differences are between the three. So first of all, when you're doing short dated options, you have a fair amount of certainty as to what's going to happen between now and expiration. So if you're trading weekly options, so this 21 to 49 days out, that's anywhere from 3 to 7 weeks out. That's the crux of where weekly options are, and really where a lot of the trading in weekly options are is in that 3 to 7 week range. In that short amount of time, you generally have a fair amount of certainty as to what's going to happen between now and expiration. So things like earnings dates, dividend dates, product launches, these types of things, you have a fair amount of visibility if you're looking only a few weeks out. Versus someone who's trading monthly options 6 months out, you may not have as much visibility into when that next earnings cycle is, when that next dividend is coming, and certainly not aware of perhaps where the next product launch is coming from. And that can usually be just a few weeks out. So that's really where you get a lot less certainty as to what's going to happen. And the difference between the two is that the more certainty you have, the less income you're going to receive. And the less certainty you have, the more income you're going to receive. So the question becomes, where are you going to get the best return on your investment when you're selling options? Because all of these strategies we're talking about involve selling options. So where do you want to sell? So based on our research, it's always best to be on the shorter end of the spectrum, meaning referring to this weekly options versus anything monthly or even longer term like the leaps. And this curve is a pretty good representation as to why. Because when we're selling options, we want time decay to work in our favor. And this chart shows you how much the option will decay based on with respect to as the passing of time. So as you can see, when an option has about 4 months to go, all the way down to 1 month, it loses about the same amount of value in those 3 months of time as it does in the last month between month 1 and month 0. So what we're seeing is that when you're trading monthly options, your option is decaying much, much slower, which is what's providing you profits in this specific scenario, which is why, generally speaking, option sellers tend to be sellers in this last range, about in the weekly options, anywhere from 0 to 1 month out, because that's where you get the best bang for your buck, because the option is going to decay much, much faster. You're going to realize the same amount of profits in 1 month as you do in the previous 3 months. And that's, again, why we generally like when we're selling options for cover calls, short puts, credit spreads, even iron condors and butterflies. For those that are trading those advanced strategies, they tend to all be traded in these weekly options because of this time decay function that is non-linear and accelerates as you get closer and closer to expiration. So because of that, that is why it is generally best practices when you're selling options to be selling options that are shorter dated, the weekly options versus monthly options. Now, again, I will say, for those of you that don't have the time to trade weekly options, this is not a solicitation for you to trade something that's not suitable for you. If you only have the time to trade monthly options, then you still should trade monthly options. Just know that your profits that you're going to expect will come a little slower than users that are trading weekly options. Next, let's talk about strike prices. How do you determine what strike price to sell? So what I have here, and the best way to think about strike prices is really based on your risk tolerance. So you can have conservative strikes, optimal strikes, or aggressive. Conservative, for those of you that are selling, is really for those of you that are, so if you're selling cover calls or short puts, you're really wanting to minimize the chances of you either owning the stock or being or having to sell your stock for the cover calls. For those of you that are selling credit spreads, conservatives are really far out of the money strikes so that you have a low probability of loss on that trade. Versus aggressive strikes are really strikes that are much closer to the current price. This gives you much higher probability of the stock being called away or the stock being called to you in the form of short put. And for those of you that are selling credit spreads, this is really much closer to the money options. So you have a higher probability of that credit spread being at a loss. And then for those of you that are somewhere in the middle, or what I call optimal, this is really kind of finding a balance between that two. So the best way to think about different strike prices, in my opinion, is actually using delta, because delta is always pegged to probability. It allows you to compare two options, apples to apples, because if you're looking at one stock that's, let's say you're looking at a blue chip stock like Coca-Cola that really doesn't move very much versus a high flying stock like Tesla, using deltas really allow you to normalize the fact that those two stocks are very, very different and have very different probabilities or different volatilities. So if you want consistency across all your stocks, you want to use delta, because a 10 delta Coca-Cola stock call will have the same probability of being called away as a 10 delta Tesla stock. And that's one of the best ways to be able to help you normalize your analysis between one stock to another. It's using these deltas. And deltas gives you an idea of what the probability of that strike price being hit or being in the money at expiration. So when we're talking about conservative strikes, these are strikes that are further away from the current price. And these are strikes that are going to give you far less income than more aggressive strikes. Aggressive strikes are the strikes that are very close to the current price, and they're going to generate much more income for your trades. So this is really thinking about, different strike selections. It really should be based on your risk tolerance, and the best thing to do is to use delta in helping you decide which strikes to choose with each one of these strategies. So now let's actually break down each one of these strategies and kind of what are your best practices to be able to generate consistent income using these strategies. So when it comes to cover calls, based on all of our back testing, it's generally best to choose more conservative strikes. So strikes that are further out of the money, about 15 to 20 delta, these tend to work best in terms of the long run to generate consistent income for cover calls. And the reason for this is actually because cover calls is the only strategy where you are exposed to the underlying stock. Now, the reason that you own the stocks is because you think the stock's going to appreciate in value. So when you're selling a very aggressive cover calls, you're limiting that ability for that stock to really run and appreciate in capital, because that's the primary reason why you own that stock. Cover calls is the secondary reason to be able to generate some income on that stock. But the primary reason of owning that stock is the reason why you want to choose conservative strikes. Give your stock that room to run to the upside before your stock gets called away. So that's what we found is the best for selling covered calls. And based on all of our findings, it's generally best to avoid selling during the earnings cycle when you're selling covered calls. So when you're selling weekly covered calls, it's easy to avoid earnings because you're only selling 3, 4, 5 weeks out. You can just avoid selling earnings and just continue when earnings have finished. Lastly, or secondly, with credit spreads, this is where it gets a little trickier, because not only do you have two strikes to worry about, you also have to worry about how far away those two strikes are. So the golden rule here is, generally speaking, is to collect the premium that's roughly about 1/3 of the width of vertical. So meaning if you're selling a 3-point vertical spread, you want to collect roughly about $1. That's generally what we have found is the golden ratio between the premium collected and the width of that vertical. And that, generally speaking, comes out to be roughly about selling a 45 delta call and then buying back about a 20 delta call, 20 delta option against it. So depending on whether you're trading call credit spreads or put credit spreads, you always want to sell roughly that near the money call or near the money option that's slightly out of the money, and then buy back that 20 delta call or put to help offset the maximum risk or to help you limit the risk of that strategy. And lastly, for short puts, we generally find that it's better to be a little bit more aggressive when it comes to selling puts, because again, the goal here is to potentially own the stock in the long run. You don't want to just sell puts and never own the stock, because then you miss out if the stock does appreciate in value. So generally speaking, you want to be a bit more aggressive when it comes to selling puts. Anywhere from 20 to 40 delta is where we find is best. And again, you want to avoid selling during earnings, because this is where you have the largest possibility of the stock moving significantly lower blowing through your strikes, and you end up owning a stock at a significantly higher price than what it's potentially trading at. So that's why, again, we generally avoid selling puts during earnings cycle. So that is what we consider the general best practices for these types of strategies. Like I said, this is not meant to be a comprehensive webinar on these strategies specifically. This is more on a high level perspective, and we do have specific webinars separately that you can watch on these individual strategies, talking about the details of them. So lastly, what I'll do is I'll wrap up with talking a little bit about exit strategies. Once you're in these trades, how do you manage them before we move on to showing you guys OptionsPlay and showing you guys how to utilize our platform to find these strategies quickly. So when we're talking about cover calls, best thing to do is only roll the position within the last week of expiration. Meaning, a lot of times I see users that tend to, if you sell a cover call and the stock shoots up, people tend to panic. They see this large unrealized loss on the short call that they've sold, so they buy it back because they don't want to have any further losses. And that's really one of the worst things to do when it comes to selling a cover call, because then you've effectively locked in a loss, and you can't have the ability, even if the stock comes back lower, to be able to make your money back or not have that large unrealized loss. So it's you'll always make sure that you wait until the last week. Make sure you capture as much of that time premium or time decay as possible. And if you need to roll that in the last week so that you avoid getting your stock called away. The second thing I want to talk about is something that I think a lot of people may not be aware of, and I tend to see that this kind of stops a lot of people from selling cover calls, is they're afraid of losing the stock at a low cost basis. So if you own a stock and you had it for 10 years or maybe even longer, you have it at a really low cost basis, and you're concerned that if your stock gets called away, you're going to have this huge tax bill, there's an easy way to avoid that, because you can buy some more stock on Monday, deliver that stock, the new tax lot, and avoid the taxable event on the low cost basis tax lot. So you don't, nothing in the IRS code says that you have to deliver first in, first out. You can always buy new stock on Monday and deliver that from a tax perspective. So keep that in mind. So if you're concerned about the tax liability of your stock being called away, there is something to reconsider on Monday, because you can buy some more stock. Secondly, with credit vertical spreads, this is really where it really depends on how far away out of the money you're selling these call credit spreads. But a general rule of thumb is that you want to cut losses when your losses exceed 100% of the credit that you received. So if you received $1 credit and you're down $1 on that trade, it's time to consider cutting your losses. Same thing with taking profits. This is really where it gets a little trickier. Credit spreads take a lot more experience to manage, because there's a lot more moving parts to it. But generally speaking, you want to take profits when you've exceeded 50% of the credit you received, if that happens in the first 2 weeks. What I mean by that is that if you get to that 50% goal and you only have 1 week left, then it may not make sense to cut or to take profits early. You might just at that point wait for the credit spread to expire worthless. So there's a lot of moving parts when it comes to credit vertical spreads. I do have a specific webinar just on that alone, so if you're interested in that, please take a look. And lastly, short puts. The best thing to do is really be prepared to own the stock, meaning make sure that you have the cash to own the stock. If you don't have the cash and you don't want to own the stock, make sure that you buy that put back before expiration. But otherwise, be prepared to own that stock. That is the reason why you're short that put. So make sure you're aware of that before you go ahead and enter those trades. So with that, let's jump over to OptionsPlay. I want to show you guys how to use our platform to quickly identify these strategies. For those of you that are brand new, this is the tool, OptionsPlay. I hope you guys have access to it, and if you don't, you can sign up for a free trial at OptionsPlay.com. What we have here is really a tool here that allows you to quickly find any strategies for trading an income on any given stock very, very quickly. So I specifically set this up just to show you guys the income tab first. Now, before I get into that, I just want to give a quick overview for those of you that are brand new. We have trade ideas and watch list here on the left-hand side of our screen. These are giving you ideas and list for what to look for. Our middle panel is our security analysis panel, designed to help you quickly find snapshot data of what's currently going on with each individual stock. And lastly, trading and income here on the right, providing you with instant strategies on trading options without having to use an options chain every single time you want to start your trade. So for those of you that have traded options before and have used the options chain, I know this is a very useful tool that everyone starts off with. However, this can be a little overwhelming for a lot of beginners, let alone once you learn how to read an option chain. I tend to find that there's a lot of things that you can't do on an option chain, like comparing one spread to another, or buying a stock instead of buying a call. You can't compare, you can't do what if scenarios to say, if the stock goes 5% higher, which strategy gives me the highest return? These are limitations of the chain. And what we want to do is build a platform that exceeded some of those limitations that you get from the option chain, while making your lives a little simpler. So the 3 panels itself is devised so that the first panel gives you what to look at, the middle panel tells you why you should consider looking at it, and lastly, the third panel tells you how you should trade that strategy. So today what I have is I set up an income watch list. These are just random names that I created and put into this watch list. These are names that I put in because many of you are familiar with it. Many of you may own this stock. Some of you may want to own some of these stocks. So I thought that would be a pretty good start for looking at cover calls and short puts. So what you want to do with our platform is we have a trading and income tab. Today I'm going to focus on the income tab. I will go over to the trading tab for credit spreads, but the income tab will give you both your cover call and short put opportunity for any given stock that you're looking at. Now, before you utilize the income tab, I recommend, or I insist that you take a look at the income settings button here at the bottom, because when we talk about automation helps feed consistency, this is really where we can help you bring some automation into your life. Instead of having to every single time look for a 30-day 20 delta option when you're selling calls, and doing that manually, going through pages and pages of these option chains, we do all of that work for you. You can just use these income settings to set what time frame is suitable for you. Do you use short-term options, medium-term options, long-term options, and select the appropriate risk tolerance, conservative, optimal, or aggressive. So when it comes to selling cover calls, I like to be on the short end of the spectrum because of how actively I trade, and because weekly options gives us the best time decay. And then I choose optimal when it comes to risk tolerance because it allows me to really seek a balance between conservative and aggressive. I'm not either one of those two extremes when it comes to cover calls, so I choose optimal. When I'm selling puts, I do the same thing in terms of time frame, but I like to be more aggressive when it comes to selling puts because I do want to own that stock and I want to maximize the yield on those short puts that I sell. So by doing this, when I save as default, I'm able to actually utilize this tool to bring automation into my life. So without having to pull up an option chain, without having to do any of those things, it immediately tells me for American Express what the cover call that suits my personal preferences are and the short put. So if I own American Express, I can click on yes, I own shares of American Express. I can enter the number of shares. So let's say I own 200 shares of American Express. Then it just tells me exactly which expiration and strike price suits my criteria first, or suits my criteria. So it tells me the September 14th 108 cover calls, which generates $78 in premium. It breaks it down in plain English for me. So for those of you that are brand new, you can learn a little bit more about how these strategies work. So telling me that the September 14th 108 calls will generate $78 in premium. They produce a 5.6% annualized return, and there's about a 79% chance this call is going to expire worthless. So this is all the resources that I need to, number one, tell me what expiration and strike price should I look at, the yields to let me know, am I getting enough return? So American Express currently yields 1.35% yield. So if I own the stock, I'm only getting 1.3%, not a very high yield. But by adding cover calls, I'm going to add an additional 5.66% on top of that, which brings my total 12-month projected yield to 7%. So I've jumped from 1.3% to 7%. That is why cover calls is the most popular trading strategy amongst options traders, not just options sellers, but all options traders, because it adds additional yield to the stocks that you own in your portfolio already without adding additional risk. All other strategies will incur adding additional risk to your portfolio. Cover call is the only one that doesn't. Conversely, if let's say I want to own American Express, and this is really where the short put comes into play. And for those of you that have never looked at short puts before but sell cover calls, you might want to, I highly recommend you to consider taking a look at this, because look at this. For selling two contracts of the 108 cover calls, I'm generating $78 in premium, but selling just a single contract of the short puts on American Express, which allows me to buy another 100 shares at 103, I'm going to generate an additional $78. So the same amount of money with the 200 shares on American Express, I'm going to generate that same amount of money by selling one put. So this allows me to buy an additional 100 shares at 103 minus the 78 cents that I'm going to collect in premium, which means that I can buy this at 102.22. So instead of buying American Express at all-time highs at 104, I can buy it down at around 102, and I'm going to generate an 11% yield just to sell this short put. And that's why I think this is one of the underrated strategies, because if you own American Express, chances are you probably wouldn't mind owning some more at a lower cost basis. And this allows you to potentially do that and generate some additional yield month after month until the put gets called away. So especially if you own a few hundred shares of some stock and you're already selling cover calls, consider selling one or maybe two contracts of a short put that allows you to pick up some additional shares along the way as you go along. And our platform makes it as easy as possible for you to find that cover call immediately by telling you exactly what strike price, what expiration date, and all the underlying information for you to quickly decide, am I getting enough yield? And at the same time, allow you to potentially pick up some more shares by selling some short puts on the stocks that you already own. So this is a great way to add some additional yield to your portfolio for those of you that are already selling cover calls, which 50% of you on this webinar said they did, but only a third of you said you sell puts. So I highly recommend for those of you that are selling cover calls, take a look at that short put strategy. It's an interesting way to add some additional yield and pick up some stock that you may already own and pick up some more shares of that stock that you already own. So once you've used our platform to help you identify your expiration date, your strike price, give you all the analytics so that you can decide instantly what strategy is best suited for you, what I want to show you guys is the trading tab. This is really where it's designed to help you, give you all the details you need to enter this trade into your broker's platform. Many of you trade at TD Ameritrade or Fidelity or Schwab. This will allow you to tell you how to enter this trade into your broker's platform, giving you all the details that you need to enter a trade ticket. And what we also have down here is what we call a strategy checklist. This is a checklist designed to help beginners avoid making mistakes. Because when you're trading options, there are so many data points that you're looking at. It's easy to overlook some of the smaller things, things like earnings date, spread and liquidity. These are all the things that we scan for and give you a red, green, and yellow guide to let you know how you're doing. So if you're looking at this thing and you see 3 greens and 1 yellow, then you're pretty much good to go on some of these, on most of these things. But if you see a bunch of red dots, that's telling you, hey, perhaps you might want to reconsider the strategy or at least be familiar with the risks before you place a trade. So we do that for both income strategies here for both cover calls and short puts. And in 1 second, I'll also show you that on the trading tab on how to utilize our tool to quickly find trading strategies. So remember, when you're looking for cover calls and short puts, which is two of the more popular trading strategies, click on the income tab here in the very upper right-hand corner. Use the income settings to create your settings, and that will allow you to make your lives a lot easier from always having to pull through pages and pages of this, manually searching for it. It automates that process, and that automation helps bring consistency into your portfolio. So when you're using these types of strategies, I know that every single call I sell will have roughly about an 80% chance of that call expiring worthless. And when I'm selling puts, I will always have a put that's roughly 70% chance of expiring worthless because of the settings that I created. So make sure you create your own settings and follow those so that you can quickly identify the best strategies for you and bring some consistency into your lives with these income strategies. Next, what I want to cover is credit spreads. So 60% of you say you sell credit spreads, but when it comes to selling credit spreads, if you're ever using a chain, you'll know that it takes a lot of time to figure out exactly which strike to sell, which strike to buy. Then you have to figure out what the net credit is. Then you have to figure out, should I trade one strike versus another strike? There's a lot of there's a lot more opportunity to play around with credit spreads than there are with cover calls and short puts. So that's really why we created this tool that allows you to compare any three strategies side by side. So traditionally, if you're bullish on a stock, you can click on this. You can click on I'm bullish and be presented with 3 bullish strategies. If you're bearish, we'll present you with 3 bearish strategies. But you can click on modify and change these into any strategies you want. So let's take a look at the Qs. And the only reason I bring up the Qs is because as the market makes all-time highs, the technology indices have not made all-time highs. They have actually started to continue to move a little lower. This is telling me that the relative strength of this sector is slowly coming lower. So perhaps I think that this is kind of hit a top and it's starting to start moving lower. So I have a loose directional view on this given sector, and maybe I want to sell a credit spread. So I'm going to look at selling a call credit spread. But I'm not sure exactly which strikes I'm going to use, so that's why I'm going to use OptionsPlay to set up a few different credit spreads and take a look at how they work out. So I'm going to take a look at a few different credit spreads. So we talked about trying to collect about 1/3 of the width of the credit spread. So here I have a $3 wide vertical, and I'm looking to collect roughly $1. So as you can see, when I move it up to the 185, 181.5, 184.5, I'm collecting roughly about $1 for a $3 wide credit spread. So I'm going to look at that. Then I might look at a different one. Maybe I want to look at a different expiration, or I want to look at a different width. So maybe this time I want to look at a $2 width instead of a $3 width. Limit my risk a little. So for that, I want to collect roughly about 67 cents or so. So it looks like the 182, 184 would be suitable for that. And maybe I just want to lastly compare that with a different expiration date. So maybe instead of going to September 7th, maybe I want to go out to September 14th. And again, let's say I want to look at a $3 wide spread. I'm looking to collect about $1. So for the longer dated option, I can go up to 182, 185. So these are the 3 different credit spreads that I'm looking at. You can put them side by side. You can play around with this. This is really designed to allow you to play around and test different scenarios and see how does each one of these strategies perform depending on how far you think the stock's going to move over a short period of time. So if you think that the Qs are going to go back down to this 177 level over the next couple of weeks, exactly which one gives you the best return, as you can see here, this one does a 97% return versus 96 versus 80. So obviously the longer dated option here isn't the best strategy if you expect the move to happen relatively quickly. But this really allows you to play around with the different scenarios and see which strategy performs best in what scenarios, and see how each one of the strategies will compare side by side, which is really important when you're trying to select the appropriate the correct strikes for a credit spread. Because again, when it comes to credit spreads, you have a lot more options. You can trade different widths, you can trade different distances, and there isn't a great way there isn't a quick rule of thumb other than the fact that you want to try to collect roughly 1/3 of the distance between the 2 strikes. That is usually how you determine how far away you want to sell, and that is usually the rule of thumb that we use as a starting point when it comes to selling cover calls. When it comes to selling credit spreads. So with that, what I want to do is I just want to wrap this up. Once you've selected the income strategy that you want to trade, lastly, what you can do is you can hit the trade button, and that brings up, again, the strategy checklist. Make sure you understand the risks of what you're trading before you go ahead and enter it. And once you're ready to do so, you have all the information to enter this directly into your broker's platform. So just a quick recap. For those of you that are looking to generate income strategies, make sure that you consider looking at these 3 strategies as an alternative to each one, meaning if you're already selling cover calls, look to sell some puts in addition to that, generate some additional income. And then for those of you that are selling vertical spreads, make sure you also take a look at cover calls and short puts. Usually very easy to manage. They're simple strategies. There's not a lot of moving parts to a cover call or short put, unlike a vertical spread. So this allows you to really take advantage of selling option premium in all market conditions when you consider all three and not just one or the other. So with that, I just want to bring this back to OptionsPlay. I'm going to open this up for Q&A. If anyone has any questions regarding anything I just spoke about, please type it into the chat window and I will answer as many questions as I have time for. Thank you so much. I really appreciate you guys taking the time out this afternoon and coming in on a Tuesday instead of Thursday, so that I'll be at the Money Show this Friday in San Francisco. I hope to see some of you there, and I'll be talking about a similar topic at the Money Show. Gary is asking, please make it easier for possible credit spreads plays to be visible on OptionsPlay. So that's what I just showed you right now, is how to set up a credit spread. Like I said, there's no right or wrong way to trade a credit spread, and everyone seems to have their own personal preferences when it comes to selling credit spreads. It's not like just selling a cover call or short put where it's fairly straightforward. There's a lot of moving parts to a credit spread. That's why we really allow you to set up any three credit spreads side by side and compare them. I know a lot of you that sell credit spreads really like to sell those high probability credit spreads. I don't like them myself. Back tests show that they're not great for the long term because, a lot of you like to sell credit spreads that have 80, even 85, 90% probability of profits. So, many of you are collecting $10 and risking $191. Back tests show that those are not great strategies to trade, but many of you continue to do that. But this really allows you to set them side by side and compare different strategies and see exactly how they compare based on different market scenarios. So that's really why we created this tool, something that you couldn't do if I'm just looking at the option chains. For short puts, is there a risk involved due to bad earnings? The stock will drop and then you own the share at a higher cost than you might otherwise want it to. Exactly. That is one of the major risks of selling short puts, and that is why one of the best practices that we have here for selling puts is to avoid selling them during earnings, is to avoid exactly that scenario. David's asking, I was assigned the stock before expiration when the stock was down due to earnings. Is that normal? That's not normal, and I don't know if you're talking about calls or puts here. You generally have a slightly higher chance of a put getting assigned to you early than a call, and that usually happens if there's a big move down before earnings. So I don't know if it was a call or a put, but those are unlikely scenarios, generally speaking. Do you have any opinion about leaps? I don't know what your thoughts on are leaps. Or you want to buy them or you want to sell them? Please let me know, and I'm happy to weigh in. Jay's asking, can you talk about the risk if there's a dividend payout on short positions? Jay, great question. So generally speaking, the only time you have a risk of an early assignment on a short option position is when you have a call that's in the money and the dividend amount is greater than the extrinsic value of that call option. So this scenario generally only happens when the dividend is about to go ex-dividend and you have usually less than a week left, because that's the only time where the extrinsic value is smaller than the dividend amount. That is the only time where it makes sense for someone on the other side who's owned that option to exercise that option, give up the free money that they basically lost on the extrinsic value because they're going to collect more on the dividend. So that's the only scenario that tends to happen when you have a true risk of early assignment. All other early assignments just happen randomly by chance, and there's really not much that you can do to avoid that. Stocks can be assigned before the Friday expiration. Any way to measure if cover call will be exercised. Again, that is the measure. If you are within the last week of expiration where the extrinsic value of that call is very little and that extrinsic value is smaller than the dividend amount that's about to be paid, that's when you're at risk of assignment. Barry is asking, is there a chart or spreadsheet where you're aware that easy on the eyes, which shows different strategies available aligned with bullishness and bearishness? So we actually do all of that just on the P&L a strategy constructor. So it's actually converted for you based on bullish, bearish, neutral. So all the strategies that are bullish are listed here. All the bearish strategies are listed here. You can do it all from here, and you can usually just click on it and it will instantly create it for you. I don't know what else you'd be looking for. Please let me know if that's not what you're doing. I am considering buying leaps puts on Qs. So if you're looking to buy leaps, leaps are actually one of the best ways to get directional exposure while minimizing your time decay. So this is really going back to this chart here, because when you're selling options, you want to be at this end of the spectrum. When you're buying options, you want to be on this end of the spectrum, because when you're buying leaps, you have very little time decay. So that's one of the few things that are working against you is time when you're buying a call or a put. So leaps minimize that time decay. So it really allows you to give you that directional exposure at a fraction of the cost of owning the stock or shorting the stock. So very big fan of buying leaps if you're looking to buy them. If you're looking to sell, not a great strategy in my opinion. Any other questions regarding anything that I went over here today? Tom is asking is, how do you evaluate selling a quantity of 2 credit spreads at a lower credit versus 1 credit spread, a higher credit? Great question. So let's look at this. Let's go back to the Qs. Let's look at selling short call vertical. Like I said, let's look at the 30-day. I was looking at about the, let's say a $4 wide, or let's do a $3 wide just for easy math. And I'm looking to collect about $1. So it looks like that's about a September 182, 185 and a half strike. So I'm collecting about $1 there. Now let's also look at a short call vertical. Let's say a $2 wide one, but I'm going to sell two contracts of that. And I'm going to go a little further out. I'm still going to try to collect about $1. So here I can select, so here I have one contract that's September 21st, 182, 180.5, so far out of the money, collecting $1, versus selling 2 contracts with a much closer, meaning just very little out of the money for the same amount of premium. So as you can see, one has a 66% chance of probability of winning, one has only a 53% chance of winning, roughly the same amount of reward, but obviously the max risk is much larger on the longer dated one. I'm sorry, when you're selling only 1 contract versus 2 contracts. So this is how you can compare the two side by side, is using this tool. You can change the quantity of any of these. So if you want to compare, 5 contracts to 3 contracts here, you can do that just by the click of a mouse. And you can always use our P&L simulator, which also tells you not only the return, but also the dollar amount. So you can compare $2 amounts of different varying quantities. That's really the key of why we created this tool, is because you can't do those things on an option chain. You can only compare one contract to another contract on an option chain. You can't compare different contract sizes or different numbers of contracts when you're just looking at an option chain. I hope that answered your question, Thomas. Any way for subscribers to get the weekly cover call list without going through Google? I'm not sure what you mean by going through Google. We publish it as a Google Doc because that's the one way that we can update that at all times, make sure that it's consistently at the same place. So you don't even have to look at our emails. You can just bookmark that link and that that's updated every single Monday. For those of you that are brand new and have never used this before, we publish a cover call report every single Monday that gets emailed out. That gives you the top cover call ideas every single week. And what we do is we sort it by the annualized return. So out of the S&P 500 stocks, what are the top stocks, what is generating the highest yields, as well as it tells you how far away from the current strike price it is. So here, as you can see, Facebook generates 7.77% yield on Monday, and this was a strike that was 10% out of the money. These are the types of opportunities that you might be looking out for if you're selling cover calls. And this is a report that we generate for free every single Friday, every single Monday. All you have to do is save this link, and then you can get access to it at any time. Going back to the leap question, when buying a leap, are you looking for specific delta, say 70 to 80 delta, your thoughts? So I usually don't think of leaps on a delta perspective, because when you're buying a leap, you're trying to compare it to buying the stock. So here, as you can see, let's go back to, let's go to Facebook. Let's say Facebook is a stock. You don't have 100. You think Facebook's going to go higher, but you don't want to spend $172 a share on it. So what can you do? So here, as you can see, buying 100 shares costs $17,000. So let's take a look at a leap. Let's look at a 1-year leap. Let's look at a June 2019 leap. What I usually do is I like to find a strike that's roughly about 20% of the cost of buying 100 shares of the stock. So here, it looks like that's roughly the 150 calls will give me about 20% of the cost of buying that stock. So let's take a look at what delta that is. That's about a 75 delta. So you're right. I don't look at specific deltas, but it always ends up being somewhere around 70 to 80 is what I tend to find it being. So that's really where, but I usually like to look at it as a percentage of the underlying as opposed to delta. It's just the way I tend to think of it, because it is a replacement for the stock. Whether you're long or short, it is a replacement for being long or short at the stock. So I usually like to think of it as a percentage of owning the stock. But that usually ends up being around 70 to 80 delta for those leaps. Robert's saying, I don't want to worry about market when travel on vacation. Best strategy to avoid a 10% or more market drop with travel insurance. Great question. I actually have a specific webinar just on this alone. It's called How to Hedge Your Portfolio Using Options. I highly recommend for those of you that once you follow along with our slides, which I have sent to you with a link to our webinar playlist. One of the webinars that we did is how to hedge your portfolio using options. And I talked about the different strategies that you can use to hedge a portfolio with buying put options on a portfolio that you own. So I highly recommend you to take a look if you're looking for quote unquote travel insurance. How do I get the trading ideas spreadsheet? For those of you that we send this email out every single Monday, so we email it out to every single person. If you have a free trial, you will get the email every single Monday to it. And like I said, you don't have to look out for the email. You just have to, you can just, here, I'll post it in the chat group. There is a link to that cover call report. You can just bookmark that report and then you can visit it every single Monday, and that will give you the updated Excel spreadsheet. Thomas, thank you very much. I really hope that you find this useful. What did you click on to convert the Excel spreadsheet for cover call rate of return? There's nothing. It's already there. It's already listed there as one of the columns. You don't have to press anything. The annualized return is right here. It's this green column. It's already sorted for you from highest to lowest. So that you don't have to do anything in addition to that. Any other questions? If there are no more questions, again, I just want to thank everyone for taking the time out this afternoon and listening to us and helping you guys learn about how to utilize these types of strategies for your portfolio, and more importantly, how to utilize our platform to quickly find the strategies that you want to trade. Like I said, we've created this platform to make your lives easier. Everything from making a beginner's life a little easier on learning how to trade options to the more advanced traders to helping you save time on analysis and being able to quickly find your starting points within a few seconds instead of minutes using the option chain. That's really why we created this platform, and I hope I'm able to show you guys the best ways to utilize our platform. So thank you very much for taking the time out every single week to come to our webinar series and learning more about how to utilize our platform and trading options. So I will be back here next Thursday on talking about how to generate. Actually, I forget what the topic is next Thursday, but I will make sure that I email that out to everyone. But we are back here next Thursday. And I will be in San Francisco at the Money Show on Friday morning at 10 a.m. For those of you that are attending, please come by. Feel free to come by and say hello. Always welcome to any feedback and questions from those of you that are attending. And I will be at the Merrill Edge booth for those of you that will be at that show. So thanks again for taking the time out this afternoon. I hope you guys find this useful. I will send out the webinar recording with the slides in about 30 minutes. So look out for that, and that will have the links to everything that I've spoken about here today. So have a great afternoon, and I'll see you guys in about 2 weeks next Thursday.